Would you believe me if I told you guys that there's a loophole in the tax code that lets you use Airbnb to wipe out your W-2 taxes? Not your rental income, your W-2, your 1099, your business income. One investor I know used this strategy and he saved over $460,000 in a single year. 460 grand. It's not shady at all. It's written straight into the tax code. And most people, including most CPAs I've ever talked to, don't even know it exists. And today, I'm gonna break it down for you guys so you guys understand. What's up, everybody? It's Rafa. I've been in short-term rentals for the past 9.5 years, and I've built a multi-7-figure business in this space, starting from arbitrage to buying my first property, to boutique hotels, and to now luxury short-term rentals with my business partner. Over the past 5 years, I've watched a lot of high-income earners, doctors, lawyers, tech guys pulling in $400,000, $500,000 a year, use this exact strategy to legally hand the IRS a whole lot less money than a regular person on their W-2. If you're new to the channel, I break down how I build, how I fund, and how I scale short-term rentals through systems and operations. That's your world. Hit subscribe. Let's get into it. So a quick disclaimer right up front. I am not a CPA. I am not your tax guy, and nothing in this video is tax or financial advice. I'm an operator and a business owner, and I'm just gonna show you what's possible so you can have a smarter conversation with your CPA. Don't do any of this that I'm about to talk to without a real professional looking at your numbers first. Before we get into the loophole, I gotta explain the problem that it actually solves, because if you don't get the problem, the solution's not really gonna hit and it's not gonna make any sense to you. When you own rental real estate, you get what's called depreciation. The IRS lets you write off the value of the property over time. It's a paper loss, even when the property's cash flowing. Sounds amazing, right? Yeah, I know, free deduction. But here's the catch, or people don't know. Those losses get stamped as passive, and passive losses only cancel out passive income, not your W-2, not your consulting gig, not your business. It's just other rental stuff, other rental properties, long-term rentals, mid-term rentals, short-term rentals. So you've got this big juicy deduction sitting here, and for most people, it's basically useless, dead in the water until the day that they sell that property, maybe 30 years from now, I don't know. And that's where the problem lies. Here's how the loophole actually works. The IRS has a rule that says rental activities are automatically passive, but, and this is the part nobody really talks about, they carved out 6 exceptions. The big one being, if the average guest stay at your property is 7 days or less, the IRS does not treat it as a rental. It treats it as a business. Short-term rentals with an average stay under 7 days are, in the eyes of the tax code, a trade or a business, not a rental. That rule was written for hotels back in the day, but it actually applies now to Airbnb, Vrbo, Booking.com, all of it. Oh, and really quick, the math on how to figure out your average stay or the average stay, because a lot of people mess this up. You take your total rental nights of the year divided by the number of separate bookings. So 100 nights across 20 bookings is a 5-day average. You're solid. You're in. It's under 7. 100 nights across 10 bookings, that's 10 days average. You're out. So make sure you understand that. It's super simple. Write that down. 7 days or less. That's the requirement. That's number one. And you need to be able to have the average for the year. Aside from that, the 7-day rule alone doesn't just cut it. There's also other rules that you have to follow. Number one, make sure that whatever hours you're doing is more than everybody else and it's over 100. I've seen this specific rule wreck everybody. They buy the property, they hire a full service manager, they sit back, they kick their feet up, and then at tax time, they realize that the manager worked way more hours than them, or they thought that they would still qualify because they were directing the property manager. They fail. It doesn't qualify. The whole strategy falls apart. Here's a quick tip I'm gonna give you guys. Track your hours from day one. Every phone call with the guest, every pricing adjustment, every time you're dealing with the maintenance issue, every time you're marketing the listing itself, log it on a spreadsheet, whatever you use, it doesn't matter. Because at tax time, the IRS doesn't care what you remember, they care what's documented. And this is an annual test every single year. You don't qualify once and write it forever. Well, you do, as long as it's only for the year that you're gonna take the depreciation. But every single year you do have to prove it. Things like how long was the property being furnished? Some of the things don't qualify are things like travel time. You can't add the plane ride from the East Coast to the West Coast as work on the property, but you could do it at the 7 days that you were at the property, furnishing 8 hours a day, or you were building the furniture, or you were helping with the construction on the rehab, whatever the case may be. If you're doing the work, it qualifies, and it just has to be more. All right, one thing I want you guys to be aware of, and I see a lot of people mix this up all the time actually, is the short-term rental loophole is not real estate professional status, or reps as they call it. It's different. It's a completely different path. 750 hours for reps. So reps means you have to be in real estate and work 750 hours in real estate. And real estate has to be your main gig, which means it's what you focus on. I qualify for reps because my entire business is real estate. I do real estate for a living, not a doctor or a lawyer trying to qualify for reps. You can still qualify. There's other ways to do it. Like if your spouse is doing the work and you're married, you can do it that way. But if you have a W-2, then you can take advantage of the STR loophole and not have to qualify for reps. You can be a full-time doctor, a full-time whatever, it doesn't matter. As long as your property has that 7-day average and you put in your 100 hours and you beat every single other person that's working in the business with you or the property with you. Your STR hours do not count towards the 750 hours for reps, because remember, the IRS says that your STR isn't a rental, it's a business, and if you own rentals, you're qualifying for reps. So if you're trying to do both, don't. And don't quote me on this, but talk to your CPA, because the rules get a little bit weird there, especially with the qualification year over year. I know you have to only do it for the first year that you're actually going to take advantage of the depreciation. For whatever year you're doing it, you have to qualify. All right, so moving forward, let's say you qualify. Now what? This is where the depreciation becomes your best friend. First, the common myth I want to kill. People think that short-term rental depreciate over 27.5 years like a regular rental, and that's wrong. Because of that 7-day rule, the IRS treats your property as non-residential, like a hotel, which means 39 years. Not a huge deal, but I see this mistake quite often. Now, let's say you've got $1 million property. You strip out the land because the land doesn't depreciate ever. And let's say you've got 800,000 of depreciable bases, a straight line over 39 years. So let's say from today to 39 years, you're gonna have $800,000 worth of depreciation. What do you do about it? About 29 grand a year in depreciation, right? Do the math. 839 years, you're talking about 29K. It's not gonna change your life, like at all. But a cost segregation is what actually does it and what actually changes it. A cost seg study is where a team of engineers and tax professionals goes through your property and breaks it down into basically its individual components: the carpet, the appliances, the cabinets, the fixtures, the landscaping, the driveway, the fence, all of it, the pool. I don't know if about a pickleball court. They might qualify a pickleball court. We should look into that one. Anyway, I build a lot of pickleball courts. And they reclassify those components into shorter depreciation buckets: 5 years, 7 years, 15 years. A good cost seg typically reclassifies 20 to 40% of your depreciation bases into shorter buckets. Now, here's the kicker though. 100% bonus depreciation is back, like permanently, which is awesome. It went away for a while. It just came back, and it was signed into, I think, law June 4th under the big beautiful bill, the OBBBA, the One Big Beautiful Bill Act. It's funny, every time I see OBBBA, I'm like, what is that? And then I was like, oh, the One Big Beautiful Bill Act. I know that that's the actual name of the bill, and it sounds kind of like a joke, but it actually applies to the property, or I'm sorry, it applies to every property that was acquired after January 19, 2025. So instead of slow dripping that depreciation over 5, 7, or 15 years, you can take all of it year one on that same $1 million property. You're not looking at a $20,000 deduction anymore. You're looking at a first year deduction of about $150,000, $200,000, sometimes $300,000, depending on the property. If you combine that with the loophole, the 7-day rule, and material participation, all of it, and that deduction eats into your W-2, like right off the top, your 1099 and your business income. I've personally done cost segs in the past where I've taken $263,000 in depreciation right off the top. Now, I qualify because I'm reps again, but for a W-2 guy, that can mean a lot of money depending on your tax bracket. So let me run the math really quick for you. A high earner making $500,000 a year at their W-2 buys a short-term rental, gets a cost seg study done, generates, let's say, $250,000 in year one depreciation. Their taxable income just went from 500,000 to 250,000 at a 37% marginal bracket. What does that mean? That's roughly 92,500 in tax savings. Year one. And I did mention the investor at the top of the video who saved 460K. That's not one property. That's a high income bracket, a higher price property, and a good CPA running the numbers right. That property was way expensive and a lot of money was put into it. But the strategy is the same one that I just walked you through. The exact same thing. This is why the high earners I know are all buying short-term rentals right now. I mean, we've sold a bunch out in Joshua Tree because of this. It's not really about the cash flow. The cash flow is awesome. The real play is the tax bill. Obviously, don't go and buy a property just for depreciation that's losing money. You know, you want to make sure that it's actually making sense for you. It's going to cash flow, or at the very least break even and save you a ton of money off your taxes that you put in your pocket. Who'd you rather pay? You rather take that money and buy a property, or do you want to take that money and pay Uncle Sam? I hope you're over here. All right. So let's get into something that I see people screw up quite often on top of everything we've already talked about. The wrong way of doing this. Someone reads an article, gets excited, goes out and buys a beach house in a market with a 30-night minimum, city regulation, HOA, whatever, doesn't check the rules, puts it on Airbnb and thinks they've got the loophole in the bag, but their average stay ends up being 14 days. They don't qualify. They just bought a vacation home and stuck themselves in a mortgage that they're gonna have to figure out how to pay. And they don't get to take advantage of the taxes on this giant property that they purchased. And this one's more common. They qualify on paper, but they never track their hours. Then they get audited 3 years later and have nothing to show. No calendar, no spreadsheets, nothing. And the IRS disallows the losses, charges back taxes, pulls penalties plus interest, and you get screwed. The right way to do this before you buy, you verify that the market allows sub 7-day stays. You know, make sure that you're in the right markets with regulations. You plan to be operationally involved at least at year one, when the cost seg hits and the deduction is the biggest. You track your hours from day one, and you work with a CPA who does this every single day, not your cousin who files 1040s or TurboTax or whoever does this, right? Do the boring work up front so that the 92K refund will actually show up. You want to do this the right way. On top of it, I want to add something that a lot of people miss before I wrap this up too. When you are trying to acquire one of these vacation rentals and you want to materially participate, don't think that you can get a property management company and then you do work on the side. A property management company will always beat you on your hours on the 100-hour minimum. Trust me. I've seen so many people buy a property and then not get this right because they think, oh, the manager's going to handle the guest communications. I've already logged in my 100 hours, but then the management company is using one cleaner, and that one cleaner is cleaning the property over and over and over and over and over. It's only going to take a month worth of cleaning. I don't know, maybe more, but it's only going to take a few hours, like a bunch of checkouts. Let's just say, let's do the math off the top of my head. 30 checkouts, 4 hours of cleaning. That's 120 hours already. You've already lost. Like, you're not going to beat them. So just make sure you guys stay on top of that. Actually, one last thing before I actually wrap it up. If you're already owning an STR and you never did a cost seg, you can still grab the benefit. It's called a look back study. Your CPA files a form. I don't know the form. I think it's like 3115 or something. I took notes, but I don't know. I don't want to give you guys inaccurate information here. Have them change in the accounting method, and then you can claim all the depreciation you missed. I had a couple buddies do that in the past, and they take it in one lump sum in the current year. You don't have to amend the old returns. So if you bought something 2 or 3 years ago and never accelerate it, talk to your CPA. There's money on the table that you probably haven't picked up yet. All right, let me hit you with the checklist so you guys get it clean, super clean. Number 1, average guest stay of 7 days or less. Total rental nights divided by the number of bookings. Number 2, material participation, 100 hours or more, and more hours than anyone else touching the property or doing the work on the property. Track it. Number 3, it's an annual test. You qualify every year that you claim the exception, or you don't qualify at all. Now, again, this one I think is only when you're going to take the depreciation for that year. So if you take it year 1, I don't think you need to do it in year 2 because you're not claiming any depreciation. But double check that. All right. Number 4, get a cost seg study done from a qualified firm. Holy cow, I got to restate that one again. Get a cost seg study from a qualified firm, not a cheap, I don't know. I don't want to call anybody cheap firm, but you know, usually 25, these things are usually 2,500 to 7,500 for a residential short-term rental case study. You want to do it from one that actually knows what the heck they're doing. It might be expensive, but trust me, the ROI is really insane. All right, number 5, use 100% bonus depreciation. I had to throw that in there because it doesn't, like, people are like, what? I mean, it's back. It's permanent. It applies to the property. As long as you acquired the property, as long as you acquired, I keep messing that word up, as long as you acquired the property after January 19th, 2025, which now we're in 2026, so I think we'll be fine. And number 6, work with a real estate CPA. This is audit sensitive. Again, don't go to TurboTax. Find a CPA. You know, I was talking to my buddy, and the reason why we hire CPAs and we hire attorneys isn't because they're doing the work for us. I mean, we want them to do the work and we want them to know what they're doing, but it's because they're going to back us up in case a situation arises where we have to be protected. An attorney, I don't hire them because I need them to draft good documents. I can do that on Claude or ChatGPT nowadays. I hire them because if something were to go down, they'd be there to back me up because that's what I pay them. They drafted the documents. They're going to be there to support me legally. Same thing with the CPA. I want them to be involved in real estate because if something goes down, I want them to know what they're talking about, right? So work with the real estate CPA. It is audit sensitive. You know, don't go cheap on this one. I tell you this from experience because I went cheap on it for a long time. I actually got audited. Went through the audit perfectly. Thank God for my bookkeeper, which get a bookkeeper. I say that all the time, get a bookkeeper. But you know, the real thing is you don't want to go cheap on these because I don't know. I don't need to repeat myself. You just don't want to go cheap on them. Find someone that knows what the heck they're doing. They're going to be expensive, but for the amount of money you're saving, it's worth it. Just take the hit. Anyway, all right. If you hit all those 6, your rental losses are no longer passive. They offset your W-2 legally. The short-term rental tax loophole is why we build the kind of properties that we build. Luxury short-term rentals in markets like Joshua Tree. We were actually going to move away from that. Luis and my business partner, great dude, by the way. If you guys don't follow him, you guys should totally follow him. But wealth of knowledge. Anyway, you know, we decided we were going to leave that market, and then we started getting a bunch of high net worth individuals and people that needed to offset their W-2s, and they're like, hey, we'll buy this house. Hey, we'll buy this house. And we're like, wow, there's an actual market for this. So we decided to kind of continue doing this. Luxury short-term rentals in markets like Joshua Tree, markets like the Smokies, I guess. The properties, they cash flow. Well, actually, they don't cash flow in the Smokies. I don't know. Don't quote me on that. A lot of people are going to give me hate for that. But the properties that we're building, because they're really high end and we're targeting really high customers and big groups, they cash flow. They appreciate, and our investors can use this exact strategy, the short-term rental, to offset their W-2. That's the real play. If this was anything else, you know, a lot of people probably wouldn't really be buying these properties. And the fact that the bonus depreciation is back, honestly, is a game changer. Anyway, guys, that's all I got for you guys. If this video was valuable, please smash the subscribe button. I drop videos every week breaking down real estates, the real side of this business, with the things that I do, the numbers, the strategies, the wins, the losses. I talk about that. I'm actually pretty open about all the downsides that I've had. I'm going to make a video about partnerships. I've had some really bad ones. But if you have any questions, if I said something wrong, again, don't quote me. I'm not a CPA. You know, drop me a comment. If you've used this loophole, tell me how much you've saved and who you went with. I'm always looking for good CPAs or good cost seg study companies. You know, I love you guys. You guys are awesome. If you guys have any questions, I read them. I reply to them. And, you know, check the links. I have a school community. I'm teaching people everything about real estate, from arbitrage to how to buy to how to set everything up, from partnerships to, I mean, I'm just like over delivering on this thing for $59 a month. Go check it out if you guys want. If not, no hard feelings. I'm going to drop stuff for free on here anyway. But anyway, last thing I'm going to say, please talk to your CPA before you do any of this. Your situation is unique. Not everybody's the same. I'm not your tax guy. I'm just the guy who sees this work over and over and over in the real world. I've done it. I've seen people do it. That being said, I love you guys. I'll see you guys on the next one.